SoFi hit an all-time high of $18.42 only a few days ago, and the company just reported 2024 results with major developments that investors must know. So, is now the time to add SoFi to your portfolio, or should you hold off? Let's dive in and find out. In this video, I will cover major developments from the 2024 results, what I think about SoFi and its value, what Wall Street's smart money says, and what you should do based on this information. As I mentioned, SoFi just reported 2024 results with several major developments that investors must know. SoFi is no longer just a lender. It has successfully transitioned into a diversified financial platform.
Can you repeat that, please?
Nearly half, or 49%, of its revenue now comes from fee-based segments, financial services and tech platform, rather than lending. SoFi announced a $5 billion two-year agreement with Blue Owl Capital Funds, its largest loan platform business agreement to date. This is a game changer. SoFi is originating loans for third parties like Fortress and Blue Owl Capital and keeping the servicing rights, generating high-margin capital-light revenue without balance sheet risk. SoFi's Galileo and Technisys landed a U.S. Treasury contract to power Direct Express debit cards for 3.4 million people receiving federal benefits. This is a major leap for the tech platform. It is huge for credibility and scales the business into government partnerships. Three major growth engines were announced: SoFi Plus membership, Invest, and credit cards. SoFi Plus is now available for a monthly fee instead of just to direct deposits, opening a massive revenue stream from gig workers. SoFi Invest is adding private market funds, a robo-advisor platform with BlackRock, and a move back into crypto. SoFi launched tailored credit cards focused on rewards and credit building with the potential for massive scale in the future.
We have great products. The reason why we're driving such strong product and member growth is because the products are very differentiated. And when we make people aware of them and they use the products, they not just use the first one and they gain trust with us, they use the second and third one.
When it comes to any stock, I let the numbers tell the story, and that involves looking at the company's financial statements. Would you buy a house without knowing the size, location, dimensions, or condition?
I don't think that's a good idea.
That is exactly what you're doing when you buy a stock without understanding the three financial statements. The balance sheet shows us how the business is funded. If assets grow faster than liabilities, equity increases, and we win. We need to remember that as a bank, liabilities are assets and assets are liabilities. While a deposit is an asset to us, we can take it at any time, so it's a liability to a bank. While a loan is a liability to us, our payments are income for the bank, so it's an asset for them. SoFi has almost $26 billion in deposits. This is massively lowering their funding costs versus borrowing from capital markets, which means less need for debt. Debt has decreased by over $2.1 billion since the company can fund its business through deposits. CEO Anthony Noto said, "We are near our long-term target of 85 to 90% funding through deposits." Retained earnings increased nearly $500 million from 2023 to 2024. In 2024, SoFi achieved its first full year of profitability. Retained earnings will continue to grow, which is huge. So what's the takeaway? SoFi's business is hitting its stride with deposits increasing, debt decreasing, and retained earnings moving in the right direction. The income statement shows us if the company is generating profits. We want to see revenues grow faster than expenses, which will grow profits. The way we determine how effective a company is at generating profits is via margin. Revenues minus expenses equals income. Income over revenues equals margin. If a company has higher revenues and lower expenses, it will have higher margins. If revenues grow faster than expenses, margins will get bigger or expand, which is what we want to see. Including provision for credit losses, SoFi generated $2.7 billion of net revenue. EBITDA was positive for the entire year for 2024. EBITDA drives valuation. Positive and growing EBITDA means increasing valuation and a promising future. Net income was almost $500 million and positive for the first time in company history. Vision and plans don't matter, earnings do. This is a significant positive development for investors. So what's the takeaway? Massive revenue growth and cost efficiency drove EBITDA and earnings to be positive for the first time, and the future looks bright. The cash flow statement tells us where the cash is generated by the company, and there are three buckets: operating, which is the cash the company generates internally; investing, which is the cash demanded for long-term growth; financing, which is the cash the company generates externally. When we add these together, we get the net change in cash. We want to see companies generating cash, making that number positive, not losing cash, which would make it negative. Operating cash flow improved by $6.1 billion from 2023 to 2024. The operating cash flow is primarily driven by the strong and positive net income that SoFi is generating. Investing cash flow is negative, which is expected, but there's a great reason why. SoFi is deploying its cash into available for sale investments, which provide a return for the company while being very liquid, so they're easy to sell fast if needed.
Well, that sounds reasonable enough.
Financing cash flow is positive, which is rare, but not for a bank. As I mentioned earlier, assets are liabilities and liabilities are assets for a bank. This also means that financing cash flow is more like operating cash flow for a bank since its liabilities, deposits, fund the business. Increasing deposits equals more funding and increasing cash flow. So what's the takeaway? While SoFi had a net cash outflow of $900 million in 2024, this is because the business is less reliant on debt and more reliant on deposits, which is a net positive for the company moving forward. Do you want to build wealth and have a proven system to pick winners and avoid losers?
No, that's not all. I want to be rich.
Investing success requires discipline, the skill of investment analysis, and the techniques that are proven. Some of the world's largest asset managers and investment banks pay me thousands of dollars a day to train their analysts. But what if you could have access to that knowledge for just a fraction of the cost?
Sounds good to me.
That is exactly why I created the Win Like Wall Street community, to give regular folks like you and me the tools and cutting-edge strategies to build wealth consistently and predictably. Don't wait. Right now, go to bit.ly/WLWS to join my exclusive community, Win Like Wall Street, where you can get the same Wall Street knowledge as the world's largest financial services firms, my Excel models, and direct access to me. See you on the inside. So what do I think about SoFi and what should you do? I'll get into that, but first let's go through my valuation. On Wall Street, we build a discounted cash flow model to measure the intrinsic value of companies. Because companies generate cash flow and we projected the 3 financial statements, we can take these future cash flows, discount them back to today to get current intrinsic value for the company.
It's easy math.
We cannot do this type of valuation with crypto, baseball cards, or art because they have no cash flows. If you want to learn how to build financial models like we do on Wall Street, scan the QR code on the screen to join my school community, Win Like Wall Street. Also, you could check out the step-by-step video I did on building a DCF model, which includes an Excel file. The link to that video is above and appears in the description. As you can see on the left, we take specific line items that we projected from the 3 financial statements. We use these line items to calculate free cash flow to the firm, or FCFF. To this, we add a terminal value, which is the value from the end of the model out to infinity, because the company does not stop operating when our model ends in 5 years. We discount these cash flows back to today to get to total enterprise value. To get to equity value, we need to subtract debt, add cash, and that gives us our intrinsic equity value. When we divide that by the shares outstanding, we get an implied share price of $16.25. Compared to the current share price, it is a 0.5% discount, which is a slight hold rating. What if you do not currently own SoFi, but you want to know when would be a good time to buy? I'll get into that later on. So what does Wall Street have to say about SoFi?
I don't know. You tell me.
Recent evaluations reflect a cautious stance among analysts, balancing SoFi's growth potential against concerns over valuation and broader economic factors. In fact, SoFi's stock fell 10% when they revealed their 2024 results. Goldman Sachs maintained a neutral rating on SoFi, adjusting the price target from $850 to $950. The firm acknowledges SoFi's growth prospects, but remains cautious due to valuation concerns and potential macroeconomic headwinds. UBS maintained a neutral rating on SoFi, raising the price target from $10.50 to $14. The firm acknowledges SoFi's growth prospects, but remains cautious due to valuation concerns and potential macroeconomic headwinds. Needham & Company maintained a buy rating on SoFi, raising the price target from $13 to $20. The firm is optimistic about SoFi's diversified revenue streams and its trajectory towards sustained profitability. This is Capital IQ. It's something that I utilize a ton. So 15 analysts cover SoFi on Wall Street. The target price range is from a low of $5, which is a 69% decline from current share price, to a high of $20, which is a 24% increase. Downside is greater than upside by almost 3 times. The median is $14, which is a 13% decline from current levels. The overall rating on a scale of 1 to 5 is 3, which is a hold rating. You should seek the advice of an investment professional always. I do not know your individual financial situation, and this content is meant to educate and is not investment advice. That being said, I personally do not have a position in SoFi, so let me tell you what I need to see to become a buyer of the stock. SoFi has been a rocket ship, up over 76% in the last year as it changes the banking game, but the stock is overextended. Like Warren Buffett, we always want to invest with a margin of safety, so the rule of thumb on Wall Street is a 20% discount to intrinsic value, which is about $13.50. I am concerned about the 17x increase in shares over the last 5 years as the company has high levels of stock-based compensation. Early stage growth companies like SoFi prefer to pay employees in stock to free up cash to reinvest in the business, but investors suffer.
I'm hoping you'll become an investor when you feel a little better and I can explain what we're doing.
Had SoFi not issued so much stock, the current share price would be $284 instead of $16. The company is subject to many regulations, over 40 in fact, ranging from Dodd-Frank banking regulations to SEC and FINRA securities regulations. I love that SoFi is completely online, which saves a ton of money on physical locations, but they are still a bank. There are significant costs to stay compliant, you're always under scrutiny, and it can hamstring visionaries like CEO Anthony Noto. SoFi hit an all-time high of $18.42 less than a week ago, and it's down over 12% since then. SoFi is sacrificing short-term profit for long-term growth as it positions itself to become the Amazon of fintech.
That's ambitious, which is good.
2024 was about margin expansion. 2025 will be about reinvesting in its invest, credit cards, and subscription services income streams. What this means is that the fundamentals will potentially suffer and cause investors to get skittish, but that will provide buying opportunities for long-term investors like us to jump in and take advantage of pullbacks, ideally in the 13 to 13.50 range. If you like this and want to see another in-depth stock valuation, check out my Apple video here or my Starbucks video here. And if you found this valuable, please share this with someone who you think would enjoy this. As always, be relentless.